Welcome to Market Call. I'm Dan Nathan. I am live at the Robinhood Summit 2025. I have Steph Guild here. Steph, as you guys know, is the Chief Investment Officer at Robinhood. She's been on our pods before. And then Carter Braxton Worth of Worth Charting. Guys, how are we?
We're good.
All right. We're all in from the East Coast. We're out here, not on the West Coast, but we are definitely out here on PST. So we're like, I don't know, maybe a little roughed up this morning. I don't know. We're
a little roughed up.
But we've been up early watching the markets, and there's some really, really interesting things going on. I think we were previewing some of the economic data that might inform what we see or what the Fed does next week and how they speak to potentially a rate cutting cycle. We're going to get Steph's take on that, what she is expecting here. Are we going to get a 25? Are we going to get a jumbo? Are we going to see 3 this year? Are we going to see 6 next year? You know, that sort of thing.
Yeah.
All right. So we're going to talk about that. We're going to talk about Oracle. What's going on right now with Oracle? This was a company that had a market cap yesterday on the close, 4 p.m. Eastern, of $678 billion. Carter, what is that today? It's nearing the trillion. It's nearing the $1 trillion club. So we're going to talk about that. We're going to talk about all the names associated with this generative AI trade and how they might be benefiting or getting hurt from that. We got a whole host of other things to go through here. So Steph, let's get into it. PPI, CPI is tomorrow morning. What are we thinking here? And is the market reacting to that, the stock market, the bond market, or is the stock market more focused on what Oracle had to guide to for next year?
Stock market more focused on Oracle, and you can see it in what's moving today. You know, you have in sympathy, you got Broadcom moving, Vistra, we were talking about, like, is that the power demand? So I actually think it's more focused on that because the expectation going into yesterday was that the Fed was going to cut, and PPI just confirms that the Fed is going to cut. Maybe it supports a 50 basis point. I mean, historically, you know, Powell hadn't started with 50, usually starts with 25 in any direction, but when he started raising with 50 too. So, you know, anything can happen. Like, there's definitely more of a case for 50 based on PPI numbers.
Yeah, no doubt. I mean, so let's just break down that, Carter, before, like, you've been watching the markets for a very long time. You've seen massive rate cutting and rate hiking cycles. Steph just gave us a sense of what Powell might or might not do. There's been a couple situations where when he started back in 2017-18, you remember it was like kind of slow and steady wins rates. He was trying to normalize interest rates for the first time really since the financial crisis, right? And so he was doing these 25s, slowly, 25s, that sort of thing. But then he had to crush it to the downside during COVID. We get that. And to Steph's point, when we started to kind of say, we're going to battle inflation here, so he started doing that a bit more aggressively. What do you think is different about this time? A year ago, we had a 50 in September. They're worried about a weakening labor market. Then they did 2 more 25 basis point cuts. What's different this time? Are you looking at this and saying, you know what, we're going to kind of get the run-of-the-mill cutting cycle here?
Yeah, I mean, I think the one thing that's not different is that the Fed is always behind. It's not their fault. They're just humans who get out of bed like the rest of us, and they might have a little bit better data, but do they really? From all of the largest asset managers and hedge fund managers in the world and all of the major sell-side broker-dealers, they're behind now, right? And so here they are. They're going to try to get caught up with the market, but the yields at the 10-year and the 2-year are already telling them what they need to do, and they are going to do it. I don't think they're doing anything aggressive. We're at 50, 75. I think it's going to be gradual because they can't afford anything that's destabilizing.
Yeah, so Steph, what do you think the equity market wants here? Because we know generally that you see this sort of move in rates going lower. It supports equity valuations here, but it really depends on what are the reasons why the Fed is cutting, right? So last Friday, we had that jobs report. It was weak. It kind of confirmed the fact. We saw Fed funds futures, the CME Fed Watch tool, suggested it was take it to the bank, 90%. You're going to get a 25 basis point cut in September. But then you look at this, you say, the PPI, if the CPI confirms, you know, kind of inflation softening a little bit, getting closer to the Fed's target of 2%, then what does that mean? Like, because are they cutting because they can, because inflation's under control, they have a dual mandate, full employment, you know, stable prices? It seems like there's some like divergence in those two things right now.
Yeah, I mean, the market, I think, wants lower inflation and a few cuts, and then not a need for more.
Yeah.
And that's what I think it's pricing in right now. It's not pricing in a slowdown. I do think that this PPI, if it's true and it continues in this direction, then it is a problem for another day that perhaps the economy is slowing down to the point where it's like it's not a good thing. It's not just a slow growth. It's pretend maybe going towards negative growth, and that's not a good thing, because then you'll start to see it in the labor market even worse, and then everything slows down for the wrong reasons.
I mean, rents are still firm, right? But I mean, other things are so soft. The grains. I mean, oil is hardly pressure. Copper's come off meaningfully from its high.
Steel was a little higher, though.
Steel's a little higher, so it's case by case, but it's not a uniform front in terms of there's a lot of pressure. A lot of things are weak. My hunch, again, is they are going to be gradual, but they are behind. They've got to get in motion.
All right, so let's get away from some of the nerdy stuff for a second here. I'm not calling you a nerd. I'm just saying we're all kind of nerding out a little bit. All right, let me go to the legend here, because let's look at the S&P 500. Let's look at it through the SPY, the SPY here. And we know what happened since the lows in April. You guys have all been riding the train. One of the things that I found, Steph, and maybe before we kind of chart this with Carter here, is that we saw a lot of data. You guys have a lot of data. Retail did not get shaken out in that downward volatility, and so in many ways they probably had lots of opportunities to buy when things were looking really hairy. And then we got to some levels here, and we'll go through them in a second. We got back to that prior high in the S&P 500, and then it's really been off to the races. It's kind of been lower left, upper right, a really steady sort of move here. Talk to us a little bit about the retail activity. I know it feels like years ago that we had that little
the blip in April.
Yeah.
We saw definitely buy the dip, and it was through the S&P 500 and things like that, like just broad-based indices at first. You saw everyone stepping in that way, and then since you've had the rally, you've seen our customers buying the dip on single names. Like whatever sells off, you had United Healthcare selling off, Lululemon, like those are things that they step into. NVIDIA goes down after earnings, they step into that, and then they trim the things that are winners.
Yeah.
But they have been in, I have to say, they're savvy. They've been in the right names.
I've met dozens of them. They're very savvy. Sometimes I feel like all those years of experience I have, not particularly useful, because I'm kind of scarred by that kind of .com implosion or the GFC post, that sort of thing. Carter, let's look at this chart. Let's look at this SPY. And we're going to get to some of those names that you just mentioned. Carter has a category every once in a while, so bad it's good. And we'll see if any of those kind of fall into that sort of bucket there. Let's look at the SPY. All right. And so tell me what you're seeing here. I'll draw some lines for you.
Sure. So I think the first thing is, and it's always this way, right? We have this really a bifurcated circumstance between the actual S&P, which is market cap weighted, and the equal weight. The equal weight S&P 500 right now is below its February peak before the tariff sell-off. So the S&P is 6+% above where it was from the February high, and it's up some 45 off the plunged low of April. But the equal weight is still yet to really make a meaningful clearance of the prior high. And that is either the good thing and the bad thing. You can make a thesis, right, that the broad market, of course, is going to catch up, right? That if you look at the multiples on the equal weight S&P, it's only maybe at 20 versus the S&P at a 27, 28. And therefore, if and as, right, the rest of the market catches up, the equal weight finally breaks out in a meaningful way, you have follow-through. The other takeaway, and a lot of people are in this camp, is that this is on borrowed time, right? Because it's just a few big names that are driving so much of the result that if and as there were to be trouble, right, it's sort of trouble in paradise. But when you see a follow-through day like Oracle, you say there's no trouble at all. The big ones are intact and so forth. My own hunch is that, again, I don't like the word expensive. It's a bad word, just as the word cheap is. Valuation is a terrible timing tool. Mm-hmm. What we do know, and there you see it there, there's the equal weight. We're stuck right now for what it's worth. The transports have yet to clear their February high, so forth and so on. The SOX just now today is only moving above its tariff swoon high. So the question is, though, forgetting valuation, because again, a terrible tool, I like the word full. The market's full.
Yeah.
Which is to say, this is a mature intermediate advance. April 7 to essentially September 7. I know we're a day or two past that. A lot of money's been pushed in, a lot of shorts have covered, and a lot of gains have been enjoyed. the real question is, and this might be something more for on a longer term basis, and there are a lot of people who are big macro running large funds saying that the long-term returns here, looking on a 3 to 5 year basis based on these levels, are going to be modest at best. And that's the question, right? Has the market cannibalized some of the perspective? Because as of now, it's an average year. I think the market's up about 11%. Markets go up about 11, 12%, depending on
Coming
dividends.
off the back of
right.
two
very strong years. So there's a story to be had and a case to be made for both sides. But I think it is full. And what's the follow-on act from here? Is it going to be earnings? Well, they're out of the way. It's going to be the Fed. We kind of know what they're going to do. What is the big move? What's the catalyst to get you going
Well, I
higher?
guess the question, we'll talk about Oracle in a couple of minutes, right? So we're going to be in a few weeks, a month into the earnings season, and I think Oracle, it could be a really bad setup for a lot of other companies that might see a bit of a pull forward or had seen a bit of a pull forward. But before we leave here, Carter, so this is the RSP, this is the equal weight S&P 500. If you didn't know that, okay, you didn't know this was an index, you didn't take all that other stuff out, do you think this little consolidation here is one of the things that, like, couldn't we see an epic breakout
Well, that's
here?
the point, that there's a case to be made that this is thing that's lagged, and if and as this breaks out. The point being that when you return to a former high, typically you contend with it before you exceed it, right? So we're back to a difficult level where memory kicks in. People from the February high have recouped all their losses. That's what the selling pressure is. And then there's memory from below. People who bought well on the lows, like, wow, I made a lot of money in 4 or 5 months, let me book it. So backing and filling is normal, but it's how it reacts from here. We've been backing and filling for about 10, 12 sessions. You need to either break out or put in that double top, because markets don't go sideways.
Right.
So,
Steph, ever think of, like, so here's the SPY, right?
Yeah.
So we just looked at the equal weight. We know that 30% of the weight of the S&P 500 is those top 7. I think a little more, 35 is the top 10. We also know that those 10 stocks are a really important part of the S&P 500 earnings growth situation here. So, Steph, when you look at this, okay, I draw a little support line, Carter. I don't know if you like it, you don't like it. I mean, it looked a lot like that RSP that we just showed you, right? But that was 2 months ago. This thing broke up, back and filled to that breakout level. We see your 150-day moving average that you like to track here. You know, the idea of a pullback towards that kind of breakout level might be the sort of spot you'd maybe reload a little bit, Steph. I'm just curious, how are you thinking about the equal weight versus the market cap weight?
Yeah, I think I've liked mid caps for probably starting in the end of June, early July. I started liking mid caps. I started liking regional, banks. I started liking things that are a little cheaper. I started liking more software names, like things that just, I call it GARP, like growth at the right price, because I just didn't want to own like the high flyers anymore, because I do actually think, like, we said that, I was talking about this yesterday, like, I think the Mag 7 is, you should treat it like every other stock. And if that as a group is a little expensive, like if the market's full, it might be that Mag 7 is full, but there's a lot of opportunity underneath, and I think that's where you need to play. But I am still a little worried about the next few weeks. Like, I know PPI came in great today, and that reinforces this rate cut and keeps the market going, but we still have CPI, and then you go into this quiet period before the Fed and before earnings, where, like, you're not getting a lot of information, and then assumptions can go negative, especially if people are like, I'm just going to book my profits and leave.
well, that's what I'm saying. There's no real catalyst day to day, week over week.
In the next few weeks.
Correct.
Like, I think earnings expectations for the next couple quarters are something around like 10%. So I think, and that's not low. So I think, like, you kind of need to decide, like, do I think that earnings could be even better, and where they can be better?
Well, in a way they'd have to be, right? Because at this point, right, I mean, the only way the market can go higher, right, is one of two ways. You either have to have earnings growth or multiple expansion.
Right.
That's it, right? There's no other.
Well, we've
and
seen
so 10% is not bad, and we've seen
multiple
multiple expansions. So
Right.
from here,
it
has to be higher earnings growth,
earnings
because
growth.
to expand the multiple without higher earnings growth would be a highly unlikely
All right,
path.
speaking of higher earnings growth, let's pull up the Oracle here. I hope you guys are all long. Okay. Hey, by the way, how many of you guys are using the Legend here? I thought that keynote last night was pretty great, and Vlad and the team went through some really cool new additions here. I've been using it. I think it's a great platform. I've grown up in the business with pro tools, if you will, institutional tools, and this thing is becoming one of the best tools that I've seen in a very long time. All right, and one of the reasons I bring that up is look how easy I can move these charts, right? Carter, if I just say, let's go back a little bit. I mean, just look at what's going on here. I know that's not log, but Carter, when's the last time you've seen a move like this where you've gained hundreds of billions of dollars in market cap in one fell swoop? I know when I did, it was May of 2023. It was NVIDIA, but talk to us.
And
a little bit
NVIDIA
about
this go around, right? Not the most recent quarter, but a couple quarters ago.
Yeah.
The happy thing is that the charts repeat, and this is a nice thing, right? We know that it broke out from its former high. It sells off, just like the market during the tariff, has the same high in February, the same low in April 7th, recovers to that level, gaps up, breaks out, and now I would put this as a gap to fade. This is excessive. There's premium in the 280, 290 calls, sell calls against the long position. I would take some measures if you're long.
Well, let's just talk about the nature of a gap like this on massive volume. Okay, so obviously that's the one day, 40% on a stock that has $700 billion market cap yesterday. Seems a bit egregious. It seems like it's not like there was a lot of short interest, and short interest in a stock with this market cap could not actually do this sort of thing. These are people, these are large institutions that are saying, I missed the boat here.
I agree.
So
That's what it was.
Talk to us about that psychology.
Well, this is why I think about it, and I say this phrase every time I talk to you. Expectations are everything when it comes to investing, and I just don't think people were paying attention to this. I still think Oracle in a lot of people's minds, and I feel like I said this yesterday too, it was the 90s tech stock, and they were more focused on other names, and then Oracle comes out and is in the game with NVIDIA and Broadcom and other players, and it's you too, and I do think like now it becomes a risk of not holding it for some people, and that's why you had a big jump in. But it does feel like a lot.
If you're buying here, I'm just going to tell you, you're doing the market thing wrong.
I would probably look at an options play if you wanted to.
All right, and we'll look at the options play. I just want to highlight something. Carter, you see that little mountain that we have all the way back there about 25 years ago, a little bit? I mean, put that in context. People are trying to make lots of comparisons, what happened in the late 90s run-up, and a lot of these names that were, in a very similar manner, meant to benefit from the biggest technological change that's ever happened in the history of the world.
Which wasn't wrong.
It wasn't
It's just
wrong.
that prices were ahead of the facts.
All right,
that's
so
right.
tell me about that when you see that little mountain.
Yeah, I mean, think about Amazon. It's really the poster child for that. The sort of the criticism at the time was that they're in the business of selling dollar bills for 80 cents. I mean, that's literally what people said. He said, what? And you have to run that through. Who would do that? But the point is that he obviously had built something. It wasn't going to be books. It was going to be everything. And you can grow into equity. It doesn't mean that you won't suffer if you're paying an excessive price. Amazon lost almost 90% of its value from its .com peak to 2002 low. Again, you can stand aside, and that's perfectly reasonable, and say, I don't want to play with something like Oracle having gapped up like this. But if one is in, the first question is, do you buy more? Someone say, yeah, I like it, I buy more. I don't think that's the prudent play. I would, again, measures. So it's trimming, it's writing a call, doing something. Now the question is, and this is much more aggressive, do you short something that has just been re-rated like this? That's bad technique, right? That's wrestling something that's way too strong, and usually you'll get a follow-through day or two. So when a stock gets reset down with a heavy volume drop in gap or reset up, there's a little bit of follow typically, but not much. Markets are not efficient, but they're very efficient on the day of a big earnings beat or miss to get a stock where it belongs. And there's a reason for this. News like this is released when markets are closed, 99.9% of the time. There are very few halts, right? So it's as it was this morning or after the close. And guess what happens? Someone goes to work on it at Goldman Sachs, a team of two. They each spend 2 hours, and Morgan Stanley, and Merrill Lynch, not to mention Fidelity and Wellington. So millions of man hours go in to figure out what's this mean. And when the market opens at 9:30, they price it exactly where many, many people with smart all over the world have decided this is probably what it's worth. And you don't typically get a lot of follow through. So a gap like this, not likely to have a lot of follow through. It's time to bet against volatility.
All right, so Steph, you just said, maybe you do something, you move your feet a little bit, maybe you look at the options. I just want to make this point that the stock closed yesterday about 240. The low print, it opened at 320. The low print on the day was 310. Here we are, we're trading at 345. Let's go to the options chain. just to kind of look and
Just
see.
see where implied
yeah,
vol
let's
went
see.
to.
Okay, so right now, I actually just want to look at, I'm going to go out to October expiration. This is going to be right before. So just by the way, if you're looking at using the legend here, I just pulled up October expiration. There's a little button on the bottom there that will take you right to at the money. So if you were just to look at the 340 put, okay, the stock's trading at 345, that will cost you $22. Let's just say you wanted to make them. Yeah, that's probably not a great way. We're going to continue to see vol come in, right? That sort of thing. And you're going to see the premiums. If the stock just stayed here, those premiums at the money are going to come in, right? And so one of the things that I like to look at in an environment like this is if I said the low print today was 310, okay? Maybe you sell that 310 put shorter dated, okay, maybe it's like in 2 weeks or something like that, and buy a longer dated put of the same strike, and I'm basically financing the purchase of a long dated put. What did Carter just say? We're likely to see a bit of a follow through, or maybe it kind of maintains some of this strength. What I'm doing here is I'm setting up to take advantage of the vol that comes in short term and helps finance a longer dated put. And so I like the idea of using calendars here. All right, let's get away from the legend for a second here, because we want to think about other sectors away from tech right now that might be able to kind of pick up these other, like we looked at the RSP, we looked at the equal weight. What are some sectors that might be able to kind of grab the baton from big tech and kind of keep this market going, Steph?
I mean, I feel like a broken record when I talk about this too, but I still like financials and I like the play on a couple of fronts. I don't love the big banks. I think their valuations are full. I think they've kind of ridden that into the sun. I like a combination of regional banks, maybe even like, let's say, an M&A bank that can take advantage of deregulation, a yield curve that may end up being like the steepest we've had in a long time, meaning long-term rates kind of hover around this 4% mark on the 10-year, and then the Fed cuts rates until we get to a recession anyway. So this is kind of like, are we in late cycle? Are we in mid-cycle? I think we're in mid-cycle. This is, to me, a strong play, and you can also benefit from, just I think like a potential for these companies to just make more money and merge. I think there's a lot of, I also think, sorry, I was just thinking about this, that there are regional banks have a lot of real estate exposure, or they tend to have more. And if you do have rates coming down and potentially mortgage rates coming down, then they can actually have maybe a better business than they've had in the past. So I actually think there's a number of things behind it.
All right, Carter, let's talk about that. So one of the things that's obviously driving some of the large money center banks right here, we'll talk about regionals in a second, is the idea that you're going to see capital markets activity, M&A, IPOs pick back up. You're also seeing, and Jamie Dimon from JP Morgan, he was at a conference, or some of his executives also yesterday, and said they're seeing massive trading pick up here. You would expect that in a year like this, right? All the conditions are in place. Net interest margins, right?
Sure.
And we know that's been a big driver of these money center banks. Do you still think, with some of the valuations, JP Morgan, 3 times tangible book, it is not traded there in a very long time. I mean, you'd have to go back to some bubble levels here. What do you do with some of these market leaders that are in this sector? When you look at the JP Morgan here, we could draw the same line horizontally, gets you, that breakout level. It really hasn't exploded off of that. What are you looking at when you see this?
Well, so these are, again, I don't think there's a lot of opportunity here. The catch-up trade in regionals, I think that does have a bit of legs. The most inquiries I'm getting in terms from institutional clients is, and this is really the most, either it's right or wrong area, it's KKR, it's Apollo, it's Carlyle, it's Ares. And so they're like, a lot of them are really betting on a continuation of this cycle, because there's a lot of delta and leverage in those businesses, right? And yet there are others who say they're so overpriced. And listen, it's always this way. That's what makes a market. My own hunch is that they're the canary in the coal mine. Watch how those act. Not so much how Goldman and Morgan Stanley act.
You think it's weird that they're putting a bunch of this private credit and ETFs that you can buy in your 401k, that sort of thing? Yeah. I mean, like, let's just look at this for one sec, Steph. Okay, so Carter just the market view is that these are very expensive. The market view is that they benefited a great deal from a lot of this financial engineering or some of the changes that we've seen in the way that financial products have been packaged. This is Apollo. This is one of the behemoths here, right? Let's look at KKR, which Carter just mentioned. I mean, these stocks are kind of stuck in the mud here a little bit. Is it valuation? Is it concerns about some of the stuff that we just mentioned about just really, we don't know how this is going to shake out, the idea of private credit and ETFs that go in 401ks, that sort of thing. I had a president of a big fund. He was on CNBC. I love the guy. I'm not going to name his name, but I almost jumped out of my chair. This is maybe 6 months ago. He said that he'd rather have his mom buy a private credit ETF in her retirement account than he would the S&P 500. I disagree. I disagree. All right, so talk to me. What do you think of this group here?
I just take a step back and say, like, see how much capital has flooded into private credit and to private equity over the last 10 years. I mean, even more, right? You had a zero interest rate environment. Money didn't cost anything. Like, you could take this kind of risk.
The perfect.
Yeah, it was like the perfect storm. And I feel like that actually could be a little bit more of a bubble than even in the tech space.
And that's why it comes up in these meetings. I mean, and to think about the volatility, these are beta. I mean, KKR was down 49%. Lost half the value it's ever created since its IPO on the tariff low. Apollo was down 45. This is, just watch these. I would say they're like a control mechanism for financials. If and as these can recoup their highs from the February sell-off, it tells you we have an all clear. And my own hunch is that those February highs are in for a while.
All right, we're going to lose Steph in a few minutes, but she said something that's really interesting that I want to go back to. You said that a lot of your customers, they look for opportunities when names that they know well, that used to be massive market leaders, or maybe they were destroying some of their competitors. You named some consumer discretionary, right? Lulu and Chipotle and a handful of others. Let's talk about some of these and talk about some of the kind of customer or investor psychology. Where do you want to start?
We can start. I don't know. Actually,
let's do Lulu. Let's do Lulu.
Yeah.
Okay.
So the thing is, I see our customer base, they tend to have these core positions. At least if you look at our Robinhood Investor Index, they tend to have core positions. Some of them are in the Mag 7. Some of them are in more kind of longer term plays. In the AI space and quantum computing, stuff like that, electric vehicles, although that's been waning. But then I think you see them trading around core positions where they trim some if they go up, and then they look for opportunities when things are down a lot. So after Lulu's earnings, you saw a tick up in buying activity here.
Really? Okay, because the stock hasn't seen an uptick since those earnings. So that means somebody is selling the crap out of this thing. All right. So Carter, when you see a chart like this, what is your first inclination?
So, just as a matter of technique, and just forget about Carter Worth. I don't know anything you don't know. This is time tested. You just don't buy stocks in downtrends. It's tempting. I'm constantly holding my own finger off oh my God, it's so cheap, bad word. Oh my God, it's down so much. It's usually a bad thing to do, especially after you drop in gap. You've dropped in gap for a reason. Now, just to put Lulu in context, the thing is down 68% from its high of about 18 months ago in 2024. And it's trading where? At 165. Okay, to put that in context, you know what it was at a financial crisis low? At the low, it was trading at $2.15. So one could say, well, it's got a lot more to go. I mean, there was someone about a year ago who was actually on CNBC making the case that this was going to do exactly what Under Armour did.
Yeah.
And guess what? It's exactly what's happening.
Wait, was that person you?
No, I wouldn't have said that.
But one thing I would say is UNH was also one of these buys after it dropped a lot, and it has bounced.
Right, but that got something that helped it.
Yeah.
The most respected individual in the history of investing decided he
Warren
would take
Buffett
a
bought a
stake.
little bit of that. Right. Well, let's talk about this.
Well, but
this is a great chart to look
He's not
at.
going to do this one.
To your point, but it did have that dropping gap. It then consolidated. Then it took another leg lower. Then that gap that you see right here, that I'm using my cursor here, that was the Warren Buffett thing. But even after that, it consolidated.
Yep.
Now it's making this move right now, Carter. I see that gap from
Yeah, it's even
I want to
up
say
more.
early May. I see that 150-day moving average that's
50
trending lower.
days kind of starting to.
Yeah. So what do you do with it right here, right now?
Right here, you almost filled the drop-in gap when the real bad news started hitting, right? So that comes into effect at 377. We're trading at 344. At 375, I would let someone else have all your shares.
All right, there we go. All right, Steph Guild was here with us. She's got to go. You're going to see her this afternoon all over the place here. Say hi to her. She loves to talk
Main
stocks
stage.
with anybody
I
who
do.
will listen.
I do.
All right, Steph, thanks
Thank
so
you for
much. All right,
having
we're going to
me.
leave. She's going to make a lot of noise. She's going to get out of here. Carter and I have another 10 minutes or so. Is that mic working? That mic there? Dan? No? Yeah? All right. Thanks, Steph. Let's clap her out there. All right. Anybody have any questions? Come up here. We'll try to answer them succinctly. Carter, where do you want to go right now? Let's go away from the legend here. Let's just kind of, where do you think, we talked about the major indices. We kind of hit yields a little bit, I mean, at least through the lens of some of this economic data. What do you think the most important drivers of the market are right now between we have CPI tomorrow, let's assume it's not too different than the PPI, we have the Fed meeting next week, let's assume we get what the CME Fed Watch tool said we're going to get, 25 basis point cut. Let's assume that this inflation data allows the Fed to hint that they're going to continue to cut interest rates. Then what are we focused on, okay?
Well, that's kind of my point. There are no immediate catalysts.
Yeah.
Now, seasonally, one could say September's a bad month, but September's almost gone. We know in principle, you wouldn't bet a lot on this. There is also the seasonal phenomenon of year-end rallies and so forth and so on. The question is, as one starts to position, and it's not an individual stock, an idiosyncratic judgment of buying and selling this stock or that stock, right? Macy's versus Lulu. It's about the equity market overall, if that is one's endeavor and one is trafficking in the SPY. What are its prospects looking out into March and April and May? Because the market, of course, is always trying to look out about 3 to 6 months. And I guess you have to say thank you for choosing a side.
Yeah.
Are you increasing your exposure to equities or are you reducing? And I would say one is right to reduce. But I have plenty of clients that are increasing exposure and many that are doing just that. They're pulling in their horns in anticipation of what is not, by their judgment, going to be a particularly robust year following the very robust year last year.
Well, sometimes investors have very short memories, but the market has a long memory, right? And so I used the term scar tissue before. Growing up, starting the business in 1997, seeing those consecutive 25% gains year after year. And you know, CC on our team, he just texted me this because I asked him, what were some of the gains that we saw in 1999, okay, before this internet bubble really popped, all right? And this is kind of some staggering sort of stuff here. Let me just find it for a second. All right, you ready? Qualcomm in 1999 went from $10 to $100. Lucent was up 175% in 98. It went up 30% in 1999. Yahoo, which was the poster child, right, for the internet bubble, was up 615% in 1998. 250% in 1999. This stock lost 90% of its value from the highs in 2000 to the lows, I want to say in 02, 03 or so. So when you think about what's going on now, it's totally different. These companies have earnings. They have massive moats. They are basically monopolies. They have these managements that are just really threading the needle, whether it's figuring out how much they need to spend to put themselves in a position to kind of take advantage of what they believe is going to be a 50-year trend, right? Like we could all say, they're navigating all the political stuff. Jensen Huang has spent a lot of time at Mar-a-Lago and, you know, with the president, whether he's in Saudi Arabia or whether he's in the White House, that sort of thing. These guys are savvy, and sadly, they're all guys, okay? Sorry, I can't. Safra Katz, I guess, at Oracle, CEO there. So, Carter, when you have that sort of memory, is it totally different this time? Because when you see a stock, and we'll kind of bookend this a little bit, like Oracle raging, right, up 40% or so. Let's just take some stock as some of the other names that are performing well. NVIDIA, you'd say, well, they supply the chips. If Oracle's got all this demand to build out data centers, great for NVIDIA. It's interesting that Microsoft, which is one of the biggest beneficiaries of this trend, the stock is unchanged on the day, which I think is kind of, or unchanged-ish or so. Broadcom, which had that huge gap last week, and maybe I'll take you guys there, is up. What is that up right now, Carter? I see it up 9.5%, and this is a great example. Maybe you can speak to this, Carter, of these the strength when you get a big gap like that. Let me just go over there. Comes out AVGO. So you're seeing some winners associated with this trade continue to go higher on the back of Oracle. Talk to me about this.
Sure. I mean, just the first, stepping back from 30,000 foot view, it really is never different. So you and I talked about this just earlier in the week. At the height of the railroads, the 50% of the entire market cap of the U.S. market and in Britain was railroads. That's tech at the time. You got a horse? That's cool. I got this thing called a train, right? That's innovation. That's technology. From 1910 to 1915, it is estimated when he introduced the Model T, Ford's earnings were growing at 100% quarter over quarter over quarter for 5 years. That's what NVIDIA is doing now. It's never different, right? Think about when you come out with the airplane, or when Alcoa comes out with aluminum, every heavy steel, all the rusting coffee pots, we got this new thing called aluminum, and it's in the Wright brothers plane eventually. There's always innovation, and when you're growing, you can look at the stats on Eastman Kodak. Wait, I could take an image of my mother who's maybe going to die next year and I'll be able to see it forever? That's an innovation like nothing ever seen. Or wait a minute, how do I copy this document? Oh, I just copy it over. I got a Xerox machine. Let's play. Meaning the innovation is always there. If you look at the quarter over quarter grade, there's nothing different about NVIDIA. There's nothing different about any of this. And the question is always what you pay for a stock. Now here's Avago having gapped up and now a little bit of a follow through. But after that first, second day, if you look at what happened in December, you get a follow through day or two, and then after that it settles in. So anything like this, it's right typically to bet against volatility after a shocking moment of volatility.
Yeah, we're going to have a panel at 9 o'clock. Our main man, Obi, who's the chief of head of education here at Robinhood, we have a panel of options experts. So check that out. We're going to talk about a lot of these strategies. We're going to start with simple strategies, buying puts, buying calls, basically buying premium, then kind of selling premium in a defined risk sort of way, and a whole host of other strategies. So check that out. Carter, what do we want to leave these folks with here a little bit? So we talked a lot about the strength that we're seeing in and around this theme that has been driving market performance. We can go away from the legend here. And then we've talked about just the psychology when you're involved in a theme like this and how it's not different. We've talked about how the equal weight S&P 500 really can't get out of its own way, which speaks to the enthusiasm about this theme.
And it's either the opportunity, if and as it does, or it's the problem.
All right, so we talked about banks. Steph likes regionals. Where do you think some of these opportunities are? They can't be in these beaten up names like we talked about. Maybe there's a little trade in those sorts of things, and maybe that's what just happened in a UNH. Where are you most focused on if you were to see the S&P 500 really be able to hold these gains, consolidate above those prior highs, really make this make the case for another leg higher into year end? What are some of the groups that you think help us get us there?
Right, so we know that the markets, the 4 or 5 big sectors are all the weighting, right? Tech is 34% or thereabouts, financials are 13, 14, and then it's industrials, healthcare. The two, and it's always time, do you stick with things that are working, right? Or do you double back and find a laggard? And a lot of people say they're lagging for a reason. There's something wrong. There's a lot of bullish momentum. Why would you go and dig around in that they call it dumpster diving? And that's why they call them value traps. But one thing that has to be considered, whether you act on it or not, is that energy is only 2.9%. The entire sector, 2.9% of the S&P. Yes, one day there'll be no use of carbon fuel, but that's way down the road. I think it's right to be buying energy as a space, whether you do it through XLE, which is an ETF, or OIH, but its weighting is so small in the market as terms of total market versus energy's part of total employment, part of the total GDP, and a part of the American economy and the global economy. So there's a laggard that I would, in terms of healthcare, I think biotech's always something. It's high risk, high reward, but those kind of binary events, if you have them on an individual basis, you risk it all. But if you own like an XBI, which captures biotech as a theme, you don't have the idiosyncratic risk, but you capture the prospective momentum of the only growth area within healthcare, because the big pharmas have no growth.
Yeah. All right, one last thing. Adobe reports after the close tomorrow. This is a stock that's been trying to tell a generative AI story. They've not been able to tell it efficiently. They are being disrupted by a whole host of competitors. The implied move in the options market, let me go, yeah, there's on the legend, is about 9%. Over the last 4 quarters, the stock has averaged 10% moves the day after earnings. They've all been down, okay? You look at this, Carter just told us what you don't do in a stock in a downtrend like this. This is a pretty nasty downtrend going back a couple of years. Carter, you see this thing trying to kind of hold these levels. You can see where my cursor is. It takes you all the way back, right? A couple years or so, back to early 2023. Is this a no touch into earnings?
Yeah, I mean, it's generally bad technique. Every once in a while, once I see that one was in a downtrend, it gapped up, and I speculated, and I made a great return. But there's an idiom in the English, the exception that proves the rule, that tests it and validates it. More often than not, it is not right to buy weakness. You want to pay up, and it's this in all of life. You want to get a cheap handbag or cheap set of shoes, or you want to get a cheap baseball player, a $400,000 baseball player. The Yankees don't do that. They pay up, and they get almost the World Series every year.
No money ball, baby. No money ball for them, yeah.
Yeah. So anyway, I wouldn't do it, but to each his own. And people could say, but the P is 16 forward, it's cheap. Tough way to go.
All right, peeps, we really appreciate you being here. This is the Market Call. We do it Monday, Tuesday, Wednesday, Thursday, 11 a.m. Go to the YouTube Risk Reversal page. Carter Braxton Worth joins us at least once a week. We go through a lot of his great work on Worth Charting. Go check out his service, worthcharting.com. You get these sorts of charts every day. So we really appreciate you being here. It's great to be at the Robinhood Summit 2025. Thanks so much. We'll see you later, guys. Thank you. Thank you.